Hey everyone, Chris Carr here, president of Freedom Home Loans, and today I'm going to walk you through the March 2022 monthly market report. And I'm going to cover four main topics today, and that's going to be home prices. What's going on with home prices? We've seen a lot of appreciation. Let me dive down into that a little bit. Number two, supply and demand. So just basic economics 101, what's going on with supply today and demand. Number three, I'll give you an update on rates, where we're headed, what's happened, where we are today. And lastly, how all that ties into net worth. So again, March 2022 monthly market report, we're going to talk about four things: home prices, supply and demand, mortgage rates, and how all that ties into household net worth. I'm going to go ahead and share my screen here and dive right in. So welcome to Freedom Home Loans monthly market report for March 2022. So first, starting off with home prices. Home price appreciation is still accelerating as of January 2022. All right, so as we look back to January of 2021, we were looking at about a 10% year over year price increase. Now we've gone up pretty much every single month through the summer months, pretty flat, but we've still seen an increase in appreciation. Now, many people think that we will still be in an appreciating market, that's for sure, but the speed of which we're heading, or the appreciation growth, will probably start to taper down a little bit. I've used this analogy in the past. It's like you're going 100 miles an hour on the freeway and you slow back down to about 80, but you're still going over the normal speed limit, which happens to be 60. Okay, so just using that analogy. Change in prices last year. So there's a couple interesting graphs here, or charts I'm going to go through that show this map in the United States. So change in prices last year. This is through Q4 of 2021. The national average at 17.5% change in price or appreciation last year, as cited by the FHFA, the governing body of Fannie and Freddie. If we take this back a little bit further, we look at the changes in prices over the last 5 years. So you've owned a home for 5 years. What has that done for you? Well, the national average is about 54% increase in price over the past 5 years. Now, I want to take this back further, just a little, or just one more slide, going back a little bit longer to 1991. So the past 30 years. This is what home ownership has and can do, and I'll dive into this later in the presentation, but change in prices since 1991. So over the past 30 years, the national average is 25.8%. All right, over 30 years. That's nearly just under 10% per year, right? So a 300% average over 30 years would be 10% per year. If we look at Colorado and Utah, the top two markets in the country, over 500% change in price in the past 30 years. I don't have a calculator on me. I'll do this real quick off the cusp, but 534, for example, in Colorado, that's a 17.8% increase per year in Colorado. So you think it's not a good time to buy? Look at what's happened in the past 30 years, all right? It's just eye-opening for me seeing in this chart that home price appreciation in Colorado over the past 30 years has been a 17% annual increase, okay? Let's look at the forecast of 2022. Now keep in mind, real estate is hyper-local. That means every individual market will ebb and flow a little bit differently than the national average. This is the national average here, taking the average of these seven forecasts here for 2022. I believe the market in Colorado Springs that we're in is still supposed to have 11 to 13% appreciation last I checked, but at a national average, it's 6%. And I ran some of my charts later on in this presentation at an even lower number than that, just to see what that impact is on home ownership. All right, so let's move on to supply and demand. I have an econ degree, economics degree. This is just econ 101, supply and demand. So where are we in this market? we are strongly, firmly still in a seller's market. All right. So we have a seller's market, we have a buyer's market, and a neutral market. A neutral market, more or less, is about 6 months of inventory. Anything less than 6 months is a seller's market. Anything more than 6 months is a buyer's market. That means the seller or the buyer, depending on what type of market we're in, has more leverage and negotiating power. Okay. The listings. So let's go into new listings. They're falling dramatically over the past 6 or 7 months, from a high back in June to the lowest it's been in about 12 months, right? So this is a little bit typical because seasonally, listings typically go down in the winter months. So keep that little seed there is just a reference point. But listings are going down. Active listings are going down. So both the new and the active listings are dropping. What that means is really just we're at a point of really low inventory, because as you see on this chart, the average days on market is still pretty strong at 19 days nationally. And I know a lot of places are lower than that, but just taking the average on the market, 19 days. If you look at 6 months as a neutral market, 19 days is pretty much still as far as you can get on that spectrum of a seller's market. Okay. Months inventory of homes for sale as a direct result of supply and demand. There is a ton of demand, lack of supply. That results in very low inventory, because as things come up for sale, they're being sold and pending and contracted very quickly. So we are now at all-time low inventory. As you look on this chart here on the very far bottom right, 1.6 months inventory nationwide is lower than where we were last December and January. So we are we're at the lowest inventory levels that we've ever been. So as we move on to the sentiment, right? So worries of a housing bubble still pretty persistent. I have this conversation numerous times a week. I'm going to wait for the crash. Oh, something's going to happen. A crash is coming. So if you look from my perspective, looking at basic economics, supply is super short. Demand is near an all-time high. Affordability is still very affordable. Rates are still relatively very low. These basic factors that my sentiment is pretty positive. But looking at consumers, 77% of consumers believe they're in a housing bubble where they live, compared to just over half of that number, or 44% of agents believe that. So we have the subject matter experts with mortgage professionals, real estate professionals, not having that quite level of sentiment as consumers. The inventory of homes is nothing like it was during the housing bubble. All right, we look at the time period 07 to 2010, the 4 years of the housing crash leading up to it. Inventory, or a month's supply, was just through the roof, massively in a seller's market, right? Or sorry, in a buyer's market. So massively in a buyer's market. That's just not the case where we're at whatsoever with inventory over the past 4 years. So you look at 18, 19, 20, 21, and just super, super low inventory. Okay, so there's not this massive just supply out there that's going to really impact prices in a negative way. We look at the distressed property sales. So again, since 2020, we're at all-time low distressed property sales. This wave of forbearance that was going to come, and lead to all these distressed sales and motivated situations. Well, that just didn't happen, and it's not going to happen. I think almost 90% of people are out of forbearance now, and the home price appreciation, they can just throw the house on the market and get, significantly more than they could 2-3 years ago. So it's just not the same situation that we maybe predicted heading into COVID. There's a lot more clarity now. We go into existing home sales, right? Existing home sales. So inventory is low. There's not a lot available. However, we hit a record home sales over the past 15 years. 6.1 million homes sold. So for existing homes, that's homes that are not newly constructed. They're existing constructed homes. Okay. All-time record 6.1 million home sales. We are projected over the next 2 to 3 years to meet or exceed that. So sales are through the roof. Inventory is definitely a problem, but there's been more transactions, more sales, more purchases than any time ever. All right. And that's not going to slow down over the next couple of months or next couple of years. It's hard to argue that we're headed to a housing bubble when there's a complete lack of inventory and sales projections are supposed to increase or remain nearly the same over the next 3 years. Okay. So we go back to, let's look at this from a credit perspective, from a lender's opinion here on just credit worthiness. If we look at the volume of loans in the billions with a credit score under 620 between 03 and 07, I mean, we're talking 300, 350, 400 billion in loan transactions or volumes with credit scores under 620. We haven't hit half of that, and we're floating around 50 billion under 620 compared to where we were prior to the crash. All right. So lending standards are still under control. This is a chart here of credit availability index, where in the housing bubble, we were up to nearly 900, 868 on this scale, means that very, very loose lending standards. Since June 2008, 2009, we've been around 100 to 200 on this index, which means lending standards are really high, and they've actually gotten stricter during COVID. So not quite anything like where we were in the housing bubble. Let's take a look at average days to close a loan. So we have seen a little bit of ebb and flow here, up and down, but pretty consistent around 45, 50 days, average days to close a loan. All right. We average about 24. In purchase loans, we were contracting and closing in 18 to 21. So not to toot our own horn here, but it is very important to get with a local mortgage specialist to understand that their ability to act quickly is going to increase the chances or likelihood of you getting an offer accepted in this market. If you're working with a local bank, a big bank, a national lender, the closing times just aren't going to be there. They're going to be more in line with this. And if you're writing a contract with a 45-day close these days and there's 27 offers, you are not going to be considered in the top group or even at all. All right. So get with a local mortgage specialist to have a more competitive offer that's going to go to work and to bat for you. All right. Let's cover down on mortgage rates here just a little bit. We look at the mortgage rates from 2018 to today. We can see a drastic jump in rates over the past few months. So reasons why this is happening. Inflation, I think, came out yesterday at 7.9% CPI. With what's going on with Ukraine and Russia, I don't think this month was supposed to be the high, but with oil prices surging, that's going to affect everything that comes into, nearly everything that comes into the consumer price index. So I expect inflation to stay for quite some time as long as this conflict is going on. And it's having a direct result on oil, which impacts transportation of goods of most every kind across the board in the CPI. We also have the Fed has stopped buying mortgage-backed securities, opened up that market. It was pretty much a flood for the bar being set of where rates were pretty consistent because the government was buying these mortgage-backed securities. That's gone. And rates just, Fed funds rate increases are projected this year. Just rates are on the rise. Okay. If we take away the last 2 years, by far the best rates of all time ever, we're still, 98, 99 percentile for the lowest rates all time. If we look at the mortgage rates going back a little bit further, so 2016, I mean, we're kind of back at these ranges we were prior to COVID. The rate projections as of February 2022 So we originally were projected to be in the threes in Q3 2022, or sorry, high threes. I'd say we're already there. I mean, most lenders' rate sheets are probably going to be in the high threes to mid fours. So rates are definitely on the rise, and I'll give an example of how that impacts buying power and home ownership and net worth in this last section. So where are they going? Like I mentioned, they're already above what was forecasted just a couple months ago, 3.94%. Like I said, most lenders are going to be near 4% on their rate sheets. So they're definitely going up. That's the projection in the forecast, at least. So let's take a little bit longer look here into this chart, just another kind of way to demonstrate what I've shown. But we're still around 2016, 2017. And again, a 3 or a 4 in front of your mortgage, your interest rate is still very, very, very strong, all things considered, going back historically. We look at the average credit score over the last 12 months. Now, while the average score has gone down from 752, which is really strong, to 737, which is still fairly strong, the credit score distribution is something I found interesting to look at. So if we just take those first 3 bars there in this chart from 500 to 650, that equates to about 7%. 7% of FICO scores are under 650. Okay, 7%. So if you're a realtor or a borrower or even another lender watching this, I mean, 93% of people have a 650 or higher credit score, right? So the products you should be interested in and that we cater to are just going to be in that range, because 93% of borrowers have a FICO score in that range. The last section I want to cover is how all of this plays into net worth. We are huge on educating and advocating our customers to make smart wealth, real estate, and mortgage decisions. The mortgage is typically the largest debt anyone will ever acquire, but if you use it smartly with a certified mortgage advisor like us, we can help demonstrate and show you how impactful that can be on your net worth. So, quote here from the chief economist at NAR: with inventory at an all-time low, buyers are still having a difficult time finding a home. Inventory is low, appraisal gaps are the norm. For people that have lower credit scores as well, it's good to look into maybe DPA, down payment assistance, or just waiting a little bit to save up, have a family member that can give you a gift so that you can be able to compete in this market. So I'm just going to wait it out. Here's what waiting it out looks to you. And if you want to pause this at any time, you can, to take a look at this and read more detail. But right here, I'm comparing a 5% down conventional loan. Okay, so 5% down conventional loan. This is waiting 6 months, 1 year, 2 years, and 3 years, taking in home price appreciation that's forecasted and the rate forecast increase over the next 3 years. All right, so what that means is if you buy today compared to, let's take the far extreme, 3 years, what's going to happen is rates are going to go up and home prices are going to go up. So if you take that same home today, if you bought it and closed today versus I'm going to wait and buy that house in 3 years, just the same house, 1, the house is going to appreciate, and 2, rates are going to increase. That means your monthly payment will be almost $800 more, $800 more to buy that same house in 3 years. All right. If we take that down to 6 months, your monthly payment will go up almost $200, and waiting 12 months or 1 year, that monthly payment's going to be almost $300. Okay. That's just the loss in cash flow in your monthly payment. Next, I want to take a look at the difference in appreciation and amortization. So if you wait for 3 years, you don't get to see that home price appreciation, which In Colorado, historically, over the past 30 years, it has been 17% per year. That's mind blowing, okay? This, I believe, is using about 4% to 5% per year, but it is tied in and synced with our software to pull home price appreciation based on Colorado Springs and where those are over the next 3 years, along with rates. So, hey, Mr. and Mrs. Buyer, hey, you want to wait 2 years to buy. I completely understand the market's super competitive. 77% of consumers think that we're in a housing bubble, all right? Professionals have a difference of opinion. Inventory is all-time low, supply is at an all-time low, demand's at an all-time high. There's no real end of this in sight, from my opinion. So you want to wait for 12 months or 2 years, that's completely fine. But what that's going to cost you and your family is $64,000 in net worth. Okay, because you're going to pay off some of that principal. That house is most likely going to appreciate, I think, at a very conservative number here. And you want to wait 2 years, that's going to cost you and your family $74,000 in wealth, right? That's a real number. In a simple way, comparing net worth of a homeowner versus net worth of a renter is almost a $300,000 difference. The average net worth of a homeowner as of 2021 is $300,000. The average net worth of a renter is $8,000. Okay? The importance of home ownership is if this doesn't explain it, and what that can do for families, for stabilities, for individuals, for generational wealth, this is put quite simply. Last complicated slide here, but again, you can pause it if you want to. This just breaks down the difference in renting versus owning or buying. Okay, so this is a rent versus own comparison. One thing to note here as well, that when you get a mortgage, your payment doesn't increase. Your payment is fixed, most likely for 30 years. That's most traditional mortgages, a 30-year fixed payment. That means your payment is going to be the same. All right. Rent has always historically increased. And in this chart, we're going with a 4% annual increase. Rent has gone up quite a bit more than that, but let's just keep it 4% for 10 years. At the end of this 10-year period, not only will you be paying rent to somebody else and having no wealth or ownership, you will pay $3,600 a month. While if you own, your payment would still be $2,982. Okay. Then you factor in, like I did in the last couple slides, amortization and appreciation. The net gain of buying a home is $292,000. This hit me coincidentally here. The net gain of buying a home is $292,000. Okay, that's the net gain of buying a home over 10 years. Most people own houses for 10 years. I'm going to go back one slide. I didn't put this together to be this way, but if you look at the difference in net worth here in this example in 2021, it is $292,000 difference in net worth, which happened to be nearly the exact same number as renting versus owning a $450,000 house in El Paso County, Colorado. Okay, so in 10 years, $300,000 of net worth, that can change families and create generational wealth. The net worth of a typical homeowner is about 40 times of a renter. Okay, that's powerful. And I'm going to end with this quote. While the booming housing market contributed significantly to the recovery of the U.S. economy, research has consistently shown that homeownership is also associated with multiple economic and social benefits to individual homeowners. Homeownership has always been an important way to build wealth. And that concludes the March 2022 monthly market report. We went over home prices and appreciation, supply and demand, mortgage rates, and how all of that impacts net worth. I just asked two things of you here. If anyone you can think of can benefit from this, please share this monthly market report with them. We would really appreciate it. And we really believe that building generational wealth through smart real estate mortgage decisions, is the most impactful way to grow and build wealth. And second and lastly, if you know anyone looking to buy, sell, or refi, that's any family, friends, or co-workers, we would be honored to earn that referral, earn that trust, and eventually earn that business. Thank you again for watching this video. Have a wonderful rest of the month. Thank you.